There's an old saying, sell in May and go away. But does that always shine true? Because I've seen Mays where Bitcoin has pumped more than 30%, and I've seen Mays where Bitcoin has dumped more than 30%. So today, we're going to have a look at all of the contributing factors to help us to make a decision if this May is going to be another pumping May or another dumping May. But before we get started, this call is for educational purposes only. Always do your own research and never invest more than you can afford to lose. So let's get started. Starting off with the last 14 years of monthly returns, the war trap that we're currently seeing in inflation, the FOMC decision, what's happening with the chair transition at the FOMC, as well as my setup and how I've analyzed the charts. So what we can see here is that May has always been a bit of a mixed bag of fruit. You can see in 2025, we were up. 2024, we were up. But then we had 23 and 22, as well as 21, where we were down up to 35%. We also had months where 2019 in May, we had Bitcoin up over 52%. Now, this made me think. For the first source of our data, of course, we still got multiple things we need to look at, but why was some Mays bullish and why was some Mays really bearish? So I came down here and I had a look, and during bull cycle years, what we found that in bull cycle years, out of 9 Mays, 6 of them finished green. Wherefore, in bear cycle years, what we found was that only 1 out of the 4 bear cycle years did Bitcoin pump during the month of May, or even finish green for that instance in the month of May. So what that leads me to believe right now is that this is very determining on if we're in a bull market cycle or a bear market cycle. And we can see that right now, 2026, we are actually in a bear cycle. So this is our first point of confirmation to say, well, we may be seeing a sell in May and go away in this particular May. So let's go to the next thing to consider, because we can't just make a decision off one single piece of data alone. So the next thing we need to look at is inflation and interest rates. Historically, when inflation is low, the Fed can cut interest rates, and that leads to more people borrowing more money for cheap because interest rates are lower, right? This usually leads to people having extra money left over in their bank accounts, which then trickle into the markets, which help us stimulate bull runs. What we can see right now in 2026, inflation is at a high. The Fed's target is at 2%, and we're currently at 3.3%, which is 1.3% over target. And a lot of this is happening due to the war. You can see that Trump has cancelled his talks in Pakistan that happened last week. The Strait of Hormuz is currently closed. The US Navy has seized Iranian tankers, and Brent oil is up much, much higher, meaning that inflation also will be much higher because oil is required for basically everything that you see in supermarkets. It comes on a truck or a boat, which requires oil in somewhere along the production line, meaning cost of living goes up, inflation goes up with it. What the Fed needs to see before actually cutting interest rates to give us that bullish scenario is we need to see the core PCE consistently below 2.5%. We need to see inflation stable. And what I say by stable is right now, inflation is a bit unstable because of what's happening in the war. Every time oil gets cut off at the Strait of Hormuz, we're seeing prices go up dramatically, especially over here in Australia. However, if we have a clear answer that, oil is now flowing through, it's been flowing through for the last 3 months, inflation will start to come down. We can have a more stable outlook. Where right now, Trump can just go and put out any tweet and the oil prices jump up dramatically overnight. That's looked at as unstable. Now, the Fed, who's in charge of cutting the interest rates, probably look at that and say, well, no, we need more stable data, not have something that's extremely volatile at $90 a barrel today and $118 the next. It's too hard to predict inflation. They also want to see 2 to 3 quarters of disinflation. That means over the next 2-3 quarters, they want to see that each quarter is obviously coming down closer and closer to their target to make the cut, not getting higher than their target, which we're currently seeing right now at 3.3%. So that's, to me, another bearish sign here in May, something else to consider. Now, oil moves everything. And what we can see is that Bitcoin, it was traveling at around 92K, and price often leads the announcement. We saw the price of Bitcoin dump before they came out and announced that the war had begun. We then saw Bitcoin pump which is another early indicator. Obviously, someone has some insider information. Before we then got the productive talks from Trump, before we then saw price just go stagnant for Bitcoin in a big sideways range. Now, the thing is what I'm going to show you guys soon in this video is the charts. And right now, it looks like we're about to come down, which means I think it's an early indicator to say the war is going to kickstart. If we have a look at recent data, we can see that negotiations have completely collapsed. The US has gone and deployed massive forces over to the Middle East, as well as seeing both sides more or less preparing for what could be the next phase of the war. Then we have another tweet here by Kyle Chassé saying that oil has surged from $70 to $118. Once again, so volatile. Core PCE is still too high. Growth is slowing. Inflation is rising. And the Fed is stuck at 3.5 to 3.7% interest rates. Also another important factor. And then we have here from Douglas McGregor. This came through this morning. Iran and US negotiations have collapsed. Massive deployments currently in the region. This seems to me like escalations may be coming rather than de-escalations, and that also leads me to believe when we're seeing war and really geopolitical tensions, we'll call it, what we can see is historically it has led to a decline before we have seen more announcements of the war actually beginning. So we're going to take a look at a chart to go into this a little bit deeper very shortly. The next thing is the FOMC meeting that's going to be taking place this Thursday. At these FOMC meetings, the Fed chair, Jerome Powell, gets together and basically announces what the policy outlook is going to look like for the next few months. More or less announcing if there's going to be interest rate cuts, hikes, or if he's going to keep interest rates steady. But he also gives a bit of an outlook to say what he's looking at to lower interest rates later. Now, right now, what we can see is that the probability of an interest rate cut is currently sitting at no change of 99.4%, meaning that there is very slim to no chances we are going to see an interest rate cut, which is once again quite bearish. We want to see, once again, like I said earlier, we want to see interest rates come down, which means people will borrow more money at a cheaper rate, which means people have more money, so it then trickles into the markets. Now, the interesting part, and what they're not telling you, is that originally there was 3 interest rate cuts planned for 2026, and right now they have cut all of those down to almost 0. There may be 1 cut in this year. However, it's looking at potentially a high chance of 0 cuts at all this year. And a lot of that stimulates off the back inflation coming from what's happening for the war. Now, one important metric is before we looked at the bullish and bearish scenarios in May. And what we'll take notice of here is that every green bull cycle May has happened when the Fed is either cutting or talking about lowering interest rates. Every red May has happened with the Fed either being restrictive or hiking interest rates, which what we're seeing right now definitely isn't a sign of the Fed bringing interest rates down or cutting, given the fact that we had 3 interest rate cuts predicted for this year, and now we're seeing potentially only 1. Next, we have the post-FOMC damage. So what you'll find is coming into these FOMC meetings, the markets usually get quite volatile. Prices move up and down very quickly. However, what we saw in July was an 8% dump. What we saw into September was 29% dump. November, 7%, and so on. The last 6 FOMC meetings that we have had have all been a dump straight after FOMC. But what we need to now look at is what data came from those FOMC meetings that gave us the dump. So what we can see here is that in July, rates were held and we only saw an 8% dump. Wherefore in September, the rates were cut by 50 points and that gave us a massive 29% dump. Usually when you get a 50% rate cut, that's telling you that something in the economy is broken and they need to stimulate. So to see a 29% dump is quite dramatic, really. But that's more or less the reasoning as to why you got that big dump. Then once again, we saw another cut here in November where it was a 25% cut. You only got 7%. But what I want to focus on is this month here at 8% and also the months of January and March where they were both 9%, 7%, and really 8%. Which if you put them all together, it gives you an average of 8%. At each 3 of these meetings, that is where rates were basically put on pause and held. And what we're seeing right now for this month is also, once again, another high chance, 99.5%, right? That rates are going to be put on hold again. The only difference is that coming into this FOMC meeting, this is going to be Jerome Powell's last meeting. After this, He's more or less going to move on and be replaced by an FOMC chair who is more so, I'm not going to call him Trump's puppet, but allegedly he's on Trump's side and Trump wants to lower interest rates. So will this FOMC be different? If it follows the data, potentially not. However, there may be a chance that it may not be as bearish as other FOMCs. For now, going off the data and knowing how every time it's been held, we have seen a dump, I'm also going to give this another bearish sign that we can add towards our analysis. So far right now, if we go back to our original plan, we can see here that we're looking at the 14-day monthly returns, the war and inflation trap, and the FOMC post pattern. So far, we have 3 bearish signs, but that's still not enough data. I want to see more because there can always be something really small that can flick the script. And when everyone's expecting something bearish to happen, what happens? Boom, the market turns bullish. So we now need to dig deeper. So like I just mentioned earlier, we have a new Fed chair coming in on May 15th. That's a really important factor. And this week, we also have the GDP numbers. Now, I personally think, and this number here that I have of my prediction of 1.3 to 1.7%, that's a prediction done by Claude based off all the research that I've done. That means that GDP may come in lower than the 2.2 expected. Now, if that's lower, that also tells you that the economy is slowing down. And a lot of this is driven from the fact that oil prices may be so high. Some of the major tech companies also are going to be reporting their earnings this week, like Google, Microsoft, and Meta, what they call the Magnificent Seven. And right now, there's also some signs that they may also come in lower. And although not confirmed, we're going to have to wait and see how they look. We also need to take into consideration that with rising oil costs, people are paying more money at the pump when they go to fill up their cars. They have less income to go and spend on things like the new iPhone or potentially Meta ads or buying things on Amazon, which can also contribute to lower earnings for this period. So we're going to have to wait and see how that then turns out. So for this right now, I'm going to call this a neutral. All right, I'm not going to call this bullish. I'm not going to call it bearish. I'm going to call it a neutral. So far, why does this May rhyme with sell in May and go away? Well, for starters, what did we see? We saw that this year is currently in a bearish year, meaning that there's a high chance with only 1 out of 4 of those bearish years actually being green for the month of May. The rest of them, all red. Bitcoin has also fallen during an FOMC meeting, especially if rates have been either lowered or put on pause. And right now we're scheduling to see them be on pause. And we've also got the post-FOMC dump and very, very high inflation at 1.3% higher than their target of 2%. Now, before we make a decision on this, and I hope so far this has given you a bit of an insight, what we need to look at is that there is some things that could change this narrative. The first thing being the FOMC meeting. Jerome Powell could come out and say that we're only seeing high inflation right now due to the fact of the war tensions. They might come to an agreement with the war over the next 7 days where they stop the ceasefire, Strait of Hormuz opens and oil flows, and that could then alleviate the issue that we're seeing right now when it comes to high oil prices and high inflation. And that could then clear up over the next few months. The issue is once again, you're not going to see those full results for the first few months. And that leads me to believe that May, which is going to start in only a few days from now, could still be bearish. So there's still option for this thesis to get killed. But before we do, what I want to do is I want to bring up the trading view chart and show you some of my own live analysis. So what we can see right here is that this white moving average, which is like a little stepping stone that you can see here, it looks like steps, that is the 21 week moving EMA. And historically in bull markets, we have touched it twice before breaking above it, which then led to the starting of the next bull market. What we can see right now is we had a bearish flag that printed all the way up to January. We then saw a dump, and now it looks like we're forming another bearish flag with once again another retest of that 21-week moving average or EMA, which we also touched in the last bearish flag before seeing another dump. Now, also, when I'm looking at this, I like to use the RSI indicators, the CCI, and the stochastic. Now, for me right now, I'm looking at this and it's telling me that we are seeing 3 levels of bearish divergence, which has historically led to a very high probability of a dump. For my target, if we're going to dump, I can see that I can get this trend line here that I have, and I can measure where we broke out from the last continuation pattern, and then measure where we could potentially break down to from this continuation pattern. And right now, I'm looking around the $48,500 to $54,000 range. And that's where, personally, I'll be reassessing my bias, and I'll be sharing it with you guys on YouTube. So make sure you're subscribed, and we'll be then reevaluating. Another thing that I'm looking at on the charts is Fibonacci. Usually, the first dump that you get in Fibonacci will reject off the 38.2 level. That tells you there's still a lot of selling pressure in the market because we could only retrace 38.2% of that potential move, right? So right now, we're seeing it getting rejected off the 50 level, which also tells us still that there is still a lot of selling pressure in the market. Where I'd want to turn around and flip bullish is if we started to see price at the 61.8 level, because that could tell me that 61.8% of the market would be now buyers more or less, or much more buying pressure than selling pressure. But right now we're seeing it get clearly rejected at the 0.5 level. So right now, if I was to make a decision, personally, I'm looking at it is going to be a sell in May and go away. Now this isn't confirmed, but once again, going off the data that we've just gone through, we have almost 5 out of 5 confirmations. We have us being in a bearish year. We have FOMC looking like we're not going to cut rates, and it looks like the Fed wants to be more restrictive due to the high inflation. We also have geopolitical war tensions, and on the charts right now, we also have bearish divergences, let alone when a new Fed chair gets announced. Historically, we have seen bearish price movement. So I hope this helps you guys to make your decision. Make sure to hit like, hit subscribe if you want to see more of this analysis, and I'll be sharing more in-depth charts and analysis in our free social media platform for crypto traders called Empire. You can sign up for free, click the link in the bio or in the description below, and you have access to see all of our analysis as we present it. Thank you for tuning in. I'll see you guys on next week's call. Bye for now.